it's all been about oil, hasn't it? So let's try and figure out now, with oil knocking at $80 per barrel, what is going to be the impact of that, coupled with currency weakness for someone like HPCL? And who better than MK Surana, the CMD at HPCL, joining us on the show right now. Mr. Surana, morning. Pleasure having you on the show today. And, you know, really, sir, with crude threatening to almost touch $80 per barrel again, would you be forced to absorb the hit again if it surges too much further, coupled with the currency weakness now at a record low?
The crude is not threatening to touch 80. It did almost touch a day back, and it is hovering around that. But as I said in the past, the 80 had been a strong resistance mark for the crude in the recent past, and it has bounced back from 80 couple of times. But yesterday's announcement of some of the oil producing countries being comfortable with the price of 80, at the same time the dollar touching a high, additional statements from US regarding the trade war, and of course a little bit of haziness on the Iran sanctions will keep the crude at this level. That's what I guess. And so far government has shown the resolve and to support the free marketing of petrol and diesel pricing, as was done earlier as per the policy. And we are continuing with this now also, and I don't think that there is a possibility of we absorbing a part of it at present.
So give us a sense then, Mr. Surana, about your marketing margins. What are they at right now? How have they fared over the last 1 year in this environment? And more importantly, given the fact that you spelled out the scenario, what is the outlook on your marketing margins?
I think I said earlier that the marketing margin, the way straight on day-to-day basis, deducting the selling price from the RTP and then saying that this is the margin, it's a bit of a confusing scenario to be presented to the people who may not be aware of the whole system. But there is a time lag between the day we buy the crude, the day we process the crude, the day the product get transferred in the market. There is an exchange rate variation, especially in the higher volatile scenario of the crude prices, product cracks, and the exchange rate. Day-to-day calculation of the marketing margin will be an incorrect thing to say, and it unnecessarily misguides the situation. So I would not like to comment on the margins X or Y or Z. It is to be a bit in overall basis.
Also, Mr. Surana, you know, since you better than anyone else would understand this, if Iran sanctions do come by, do you see a further spike in crude prices coming in? And if that were to be the case, how is it that you're planning to divert or manage your sourcing from Iran?
As far as the crude barrels are concerned, there are alternative crudes to Iran crude available. So availability of the crude quantity as such is not a problem. But when in the overall system certain crude barrels are lesser than what it used to be, it does create a pressure on the pricing part of it. And therefore, if Iran barrels have to go out of the market completely, then that would mean that there is an overall supply situation either has to be met by other producing countries, or that will be short, and to that extent there will be a price impact on that. Of late, OPEC countries did increase the the crude supplies. I think in August it was almost 32.57 million barrels. Saudi Arabia increased by almost 0.12 million barrel, and Iraq also increased by 0.1 million barrel. Russia also has said that they have got a capacity to increase by almost 300,000 barrels capacity. Saudi Arabia may have some more capacity to put in the market. There is a little bit of stability on the Libya and Nigeria front in the supplies than what it used to be. And if this factor remains, of course, the recent hurricanes in US Gulf Coast has some impact. But if the other oil producing countries are able to put additional barrels, then the price should remain the way it is. But if the other oil producing countries are not able to put additional barrels and the Iran barrels goes completely out, then in the near future we may see a little bit of price impact. But still the view is that it should be around this range rather than going much higher, or let's say maybe going above 85 is unlikely. So we still expect it to be in this range of 80.
Yes, indeed. What about GRMs going forward? They have managed to see a rebound, but what about the last of 10 to 15 days? Do you see the trajectory improving?
GRMs had been good in recent past and supported mainly by gas oil cracks. Gasoline cracks had been weaker. Gas oil cracks are likely to continue to be stronger, and to that extent it should support the GRM. We expect it to be in the range of 6 or so, 6 plus, I will put it.
Due to the higher prices, will the volumes of petrol and diesel as well take a hit? Mr. Surana was wondering if the volumes will for petrol and diesel take a hit. Are you seeing some sort of a demand destruction?
I am not able to hear you further.
I think then we'll call it a day then. Thank you so much. Perhaps we'll just repatch that line in a moment if we can. But that's the verdict coming in from Mr. Surana of HPCL, and talking about the implications of the higher crude oil prices, saying that other producers as well may have to hike the output. He's fairly confident as well now of the crude oil prices remaining elevated at these kind of levels. We will perhaps just be reconnecting with him to talk about the demand destruction as well, along with their massive capex plans that the company had announced. HPCL, as we speak, is quoting at close to the highest point of the trading day at 252. But as Aisha said, we're dealing with an awfully choppy market at hand right now. The mid caps are veering towards the red. The Nifty is just about holding its head around the 11,300 mark, which is where we opened for trade, but not really showing you any conviction in terms of sustaining around these levels. Of course, there are names like ONGC, Dr. Reddy's, Coal India, Axis Bank, which are lending a helping hand. GAIL, Bajaj Auto, as well as M&M are firmly in the green, while you do have a whole host of stocks from the broader end of the market as well that are holding out. Mr. Surana, if you can hear me clearly, I was just asking, are you witnessing any demand destruction due to the higher prices, and do you think that the volumes of your petrol and diesel could potentially be hit?
In August month there was a good demand. If you see April to April month, as far as August is concerned, petrol did grow by 7.8% and HSD by 4.7%. In the month of July also we saw 7.9% growth in MS and 5% growth in diesel. So as of today we have not seen the demand destruction, but if the crude prices continue to go higher, there may be the motivation for the people to have an expeditious work on the alternate sources, as well as the consumers may also start looking for more efficient way of doing, like pulling the cars, etc. But as of today we have not seen the demand destruction. Maybe that because the growth is good, the GDP growth in the last quarter was almost 8.2%. There is a good consumer vehicles market also is good. There is also a shift from diesel vehicle to petrol vehicles, which may be driving the petrol growth. If you see the total percentage of petrol vehicles in the overall basket of the vehicles, it is more moving towards MS now than what it used to be. And the some of the parts of the country not witnessing good rains may need the diesel demand for the irrigation work.
Okay. Mr. Surana, wanted to understand about the 60,000 crore rupee capex which you've announced. What else will be spent in, and in how many phases do you plan to actually deploy this capex?
As I mentioned, the 60,000 crore is for the next 5 years capex, fundamentally for the refinery expansion for Mumbai and Vizag. Mumbai refinery is around 5,000 crore and Vizag expansion is around 20,000 crore, and these two projects are likely to be completed by 2021, and this will also have the bottom upgradation and the Euro 6 fuel facilities. The third project is the Rajasthan refinery project, which is likely to come by 20 to 23, and then we have got a cross-country pipeline expansion, marketing infrastructure expansion, some of the CGD networks, our natural gas, renewables, all those things are there. And the marketing LPG plants, terminals, depots, aviation sectors, it is all together. Marketing projects have got a shorter life cycle, and the refineries expansion have got slightly longer cycle, but the Mumbai and Vizag refinery expansion is supposed to get commissioned by end of 2020 or early 21.
And finally, Mr. Surana, based on any talks or discussions that you may have had with the government, are there any indications that you're picking up that taxes could be rationalized which make almost 5% of the costs?
Yeah, taxes do form a substantial part of the total prices, and of course this for the state government and the central government to look into it. Any rationalization done on the taxes will definitely be beneficial for the consumers, and will also be happy to that extent. And of course there has been, oil industry has been proposing that if we can bring the petroleum products, all of the petroleum products, some are already there in GST, it will help in rationalization of the taxes. Now there is a state government who have to look on the VAT part of it. There is a excise component which is central government. Some of the states did have announced the cuts recently, 3 states I suppose, and governments have to work on that. On taxation part I can't comment as such.
All right, we'll let you go on that note. But thank you so much, Mr. Surana, for giving us a heads up as to what exactly this means for your business, the rationalization of taxes, outlook on your GRMs as well, around $6 a barrel is what the management of HPCL has said.